Economics, finance, investment, and international relations. This is Bloomberg Surveillance on Bloomberg Radio, YouTube, and Bloomberg Originals.
Good morning, everyone. Tom Keene, Paul Sweeney, Michael Barr, Lisa Mateo. We welcome you across the nation and around the world. In this hour, a special treat.
Wow.
They have never been together before.
In the same room.
With me in the same room, spanning the globe. Neil Dutta and also Jeff deGraaf will be with us. The two together, Renaissance Macro, with a brief on this historic bull market, this odd American economy. We're going to deGraaf and Dutta here. Let me explain what we're doing here. At every firm, big, small, indifferent, there's a wonderful, delicious tension between the animals that follow the markets and the people that follow the economy. They're sort of separate, but not.
Yep.
RenMac, or Renaissance Macro, does as good a job as anybody worldwide at blending the two in the back and forth daily grind of following markets and executing market economics. Jeffrey deGraaf is chairman, Neil Dutta, head of economic research, and to have both of them in our studio is a real treat. How was Renaissance Macro invented? That famous picture of Lehman falling apart, was RenMac invented right there?
It was not, Tom. I had actually left Lehman Brothers about a year prior to the demise of Lehman, and I went over to Ed Hyman's shop, at ISI, because he was creating this kind of macro juggernaut, and I said, I want to be a part of that. And so I was there for 4 years. He started building it out into more fundamental research, and just wasn't something that really appealed to me.
Right.
So we pulled the ripcord and started RenMac, and had the good fortune of picking up my friend over here, Neil Dutta.
I mean, Neil Dutta, with all of his work as well, full disclosure, a couple of years ago, my economist of the year. We're not going to do like, what's the Fed going to do here? I want to talk for global Wall Street about the synthesis of research. Jeff, let me start with you, because Dutta's putting out 3 charts an hour. You and I are technical animals. I mean, it goes back to John Maggie and A.W. Cohen and that. What is the trend of the market right now that overlays on Neil Dutta economics?
Well, I'd say the trend of the market's clearly positive, and I think a lot of that has to do with Neil's call on the Fed, right, which is expecting that the Fed's going to come to the rescue and certainly start to ease, and I think the market's seeing that. And you're seeing that in cyclicality versus, say, defensive still, which I think is important. The real call for us is going to be in this fourth quarter is, do we lose that cyclicality for defensives? If that's the case, then I think the Fed is behind, way behind, and I think that's the issue. So far, that's not happening, and we're keeping a bullish posture, but that's certainly on the top of the radar.
Dutta's entourage just sent me a note. Ask Neil a question, put a cork in deGraaf's mouth. Okay, let's go there right now. You were Mr. Optimist. And about 12 months ago, 18 months ago, you said, wait a minute, I'm looking at the tea leaves and I'm cautious. Into Q4, into 2026, which way do you tilt, with optimism or caution?
Caution. I mean, for me, I think right now we have sort of a housing-centered view of the world out. And I think what's interesting is, interest rates have been coming down, but you haven't really seen housing demand improve in any meaningful way. And to me, that's sort of a yellow flag on the outlook. Builders seem to have sort of hit their pivot point on margins. And I think that's going to mean less construction activity, and I think that's going to bleed into employment. I do. And if you start seeing construction workers let go in an environment where you're not really creating much jobs growth to begin with, I think that's sort of another potential source of upward pressure on the unemployment rate. So I do think the Fed is a little bit behind here. The fact that they're kind of taking a meeting-by-meeting approach as opposed to just giving guidance into the first half of next year, I think is a little, it's a bit of a mistake. But yeah, I would just say that the housing market is softening. That's going to bleed into the labor markets. That's going to mean weaker real income growth, which kind of challenges consumer spending.
Right.
So should the Fed be more aggressive than maybe the market's pricing in right now? Should they maybe be a little bit more front-end loaded?
I think so. I mean, I think I mean, they will go more than the markets expect, I believe. I mean, that's ultimately the whole point, right? Is like, what do you think? What is the market pricing in? That's what our business is, right? What is the market pricing in, and what do you think the likely outcome is going to be, right? And the market, I think, is probably on sides for what's going to happen this year. But if you look at 2026, it looks like the markets are barely priced for 2 cuts.
Paul, on sides is the word that Dutta uses. Year to date, NASDAQ comp, not the 100, up 18%.
Boom.
It's going to be a tough year. We're single digit. deGraaf's pulling his hair out saying, no, get on board. I mean, that's what we saw continue.
So, Jeff, again, as Tom says, there's a lot of crosswinds out there. Let's call them crosswinds. Geopolitical issues. We've got domestic issues with tariff policies and just on and on and on.
Yeah.
Yet the markets are ripping,
Yeah.
other than the dollar,
Yeah.
which is still kind of cautious. What do you make of just as you step back and look at the markets?
Well, you hit a really important point, which gets underappreciated, which is there's a global bull market happening, right? So all the concern about tariffs, and I get it. I mean, we all know it. That just is not resonating with markets, which are saying there's something else here that's happening, right? And this isn't just the G7 or even the G20. Look at the frontier markets; they look fabulous, right?
Yep, you're right.
So I think to put the narrative on it, we try not to do. We're trying to be purists in how we look at things in the world. Now I'm a little concerned about gold. We entered bubble territory, but the rest of it looks pretty good to us. So look, I'm in the camp that we get a consolidation, but if Neil's world ends up developing, I think that's extraordinarily bullish for equities because we have not seen the markets fall apart when we've got yields coming in. And I think that's one thing when people are talking about bubbles, they miss the idea that, look, housing bubble, yields were going up for a year. .com, yields were going up for 9 months. 2021, yields were going up, right? Here we're actually on the cusp of the potential of yields coming down in what is, I'd say, a bit of a speculative market, but not nearly anything what we've seen before.
Special treat for Bloomberg surveillance across the nation, around the world on YouTube. Subscribe to Bloomberg Podcast. Jeffrey deGraaf, Neil Dutta of Renaissance Macro together in our studios with our remits of economics and following the markets. So I'm interviewing Chris Waller in a speech at Council on Foreign Relations. Neil, I'm going to switch this here. I'm going to go to you on economics, Jeff, to create some wonderful tension. There's a single sentence, which is Marty Zweig 101. Don't fight the Fed. I mean, we're really right back to that with a modeled 4 or 5 rate cuts from Governor Waller.
Yeah, I 100% agree. And I think you can distill that down to how does discretionary act on a relative basis. And right now, while it's not a lock, discretionary is still in an uptrend on a relative basis. And I think that's good news. Which says,
continue.
I was just say, it just says to us that the Fed is still playing this game, that they're not behind yet to the point that it's affecting those consumer names.
We go to financial analyst Neil Dutta right now. And on the markets here, come on, nominal GDP pops right over to it. Somebody had a bar chart in the zeitgeist in the last 2 days of the complete misjudge on what GDP and nominal GDP have done. Does that continue to spur revenues and down the income statement?
Well, I don't think nominal GDP is really growing as rapidly as the GDP tracking numbers are kind of telling us. I mean, I think one rule in business economics is, when there's a big disconnect between GDP and employment, you tend to go with the employment data. Obviously, the fact that total hours worked are barely positive over the last 3 months. I mean, they may in fact be negative. That would suggest that GDP growth is probably overstated, and so I tend to put more weight on employment. So, but I do think that's an important question for the market, right? I mean, obviously the bond market is pricing in a much different nominal growth outlook than equities, and how that reconciles, I think, will be an important question for next year. And I mean, basically, what squares the circle, I think, is a productivity boom. That's really what kind of resolves all these tensions, I think, in the market. Because if let's say the 10-year yield is below 4%. If that's the nominal growth outlook, how do you justify the earnings expectations that are embedded in current market pricing? Only productivity makes that happen. And if productivity doesn't show up, then there's some risk to equities.
Maybe it's all AI. Maybe that's doing it for us. Jeff, what do you make of the dollar here? We've had it stabilize, but equities have bounced back to all-time highs. Yields are coming in, but the dollar's just kind of hanging down here. What does that tell you?
Yeah, it doesn't tell us a lot, honestly. I think there's flow data with tariffs and the leverage points that as we still negotiate our ways through this. I think it's important to realize that gold got into a parabolic state, over the last, call it 6 weeks, as the dollar actually strengthened and certainly firmed, right?
Firmed,
so, there's more to the gold story than it's just the weak dollar story. And frankly, one of the things that I like about gold, I do think that it's going to take a pretty significant pause here. But I think one of the things that's interesting is that there hasn't been a single narrative. Usually when you get into these bubbles, everybody knows what the single narrative is, right? And you can ask the question, and I think there's 3 or 4 probably correct answers, but it's not, the market hasn't decided on one. And that's where you get into trouble usually. So I'm actually still optimistic about that.
Okay, can we go narrow, Neil? Is it okay if I go like nuts to graph right now? You're talking, the microanalysis of his note. Get his note from Renaissance Macro folks. And you mentioned Gilead Science. The healthcare. Healthcare has been an absolute train wreck sector.
Yes.
How does someone like you, combining fundamentals and particularly technical dynamics, know when to pull the trigger and go long healthcare? How do you do that?
Well, it's a process. And so the first thing that we start with, Tom, is we look at what we call our SERM, standardized excess return. And that's really just a fancy way to say a longer term alpha generation model, right? In other words, we're looking at how much alpha has been generated for the sector, in this case healthcare, over the last 3 to 5 years. And if we compare that to the sector since the 1960s, we've got singularly the worst alpha generation we've ever seen, right? And that's capital markets. It's gonna result in bankruptcies. It's gonna result in M&A, everything else. Okay, so that's the contrarian. That unless you believe that these things are going to zero as a sector, which doesn't happen, that's not going to happen. Then we wait for momentum. We wait for trends. We wait for momentum to confirm that, and that's where we lean into it. We did it with China about a year ago. We're doing it with healthcare now.
Look, this is so important, folks. This goes back to Ed Hyman. This goes back to John Murphy, the melding of this, of Neil Dutta's economics, Jeff deGraaf's, I'm going to call it technical bias, and then over to fundamental analysis is the religion here. Okay, so you're there, but value investing is basically cratered and only does well given down markets. We haven't had a down market. Is your tone at the shop growthiness, or is it a value search?
No, it is. We will take what the market gives us. We will go with the hot hand.
What's the market giving you right now?
The market is giving you growth. It's giving you. It's not giving you value. It's giving you beta, but we think beta is actually stretched, and we actually believe that the market is going to transition from beta at any price and transition that into momentum. And that'll be an interesting play because that's usually what happens, and that's where you get into the final stages of a bull market, and we're not there yet.
Neil, you've been talking a lot this morning about labor. How does the change in immigration policy affect kind of the analysis of the labor market here? Because there was a lot of folks coming into this country, taking a lot of jobs, and they're not coming in anymore.
I personally think that's more of a red herring, honestly. Okay. To me, it's interesting because we're talking about how break-even rates on employment have come down, meaning what do you need to keep the unemployment rate flat? Precisely at the time where the unemployment rate's been actually rising a little bit more rapidly than it has in over the last year or so. It's up basically. Had the September data been released, it probably would have been up 3 months in a row by a tenth. The break-even rate has come down, but it hasn't come down enough to keep the unemployment rate from going up in the first place. And that to me is what's important. And if you look at these areas of the economy that are sensitive to immigration, you don't really see upward wage pressure in construction employment, in sort of, sanitation, these sort of sectors where there's a lot of low-skilled work. So I don't know. I think to me, it's a bit of a red herring. And of course, look at what people are saying about job finding rates. They're telling you it's getting more difficult to find work.
Right.
And when consumers tell you labor markets are getting worse, I think it pays to believe them.
I'm hearing this from listeners and viewers as well. So Neil Dutt, I asked this of Waller. Let me ask it of you. Are we so polarized in our John Edwards 2 Americas that we literally have to operate with a study of 2 R-stars, the haves and the have-nots? Are we that separate now where aggregation of data doesn't work?
Well, I don't believe so. I think ultimately, all of these things will kind of net out over time. What you're talking about basically is this sort of K-shaped economy, right? Like this idea that the upper income. I mean, and that's a huge source of pushback that I get in our own client meetings,
Did you
right?
just throw a tape dispenser at him when he says K-shaped?
We usually mud wrestle for the
K-shaped? I hear K. Remember V-shaped?
Yeah, I do.
Oh, I remember V-shaped, Tom.
And the W. I remember the W.
We got to
the
come
U.
back with you. Jeff deGraaf, let's keep it clean. We're on radio worldwide with a license. This is the biggest amount of BS I've ever heard. What in God's name to Jeff deGraaf is K-shaped?
I have no idea.
Okay, we'll leave it there. Jeff deGraaf, Neil Dutta with us. We're going to go to the news, but they will continue with us across
Second
the nation
block.
and worldwide. You have the two together
guys must
from
be important.
Renaissance Macro. We'll see what Neil Dutta, if he throws a tape dispenser at Jeff deGraaf as well. Bloomberg. We're going to continue, folks. Stay with us here. Jeff deGraaf and Neil Dutta with us. Paul, we got to frame this out. You and I lived this, where the academics of the firm fought like cats and dogs.
Sure.
Most firms had this beautiful "we are the world" front. But back and beneath, Ethan Harris is going to Neil Dutta, you young twerp, this is what we think economics is doing at Lehman.
Exactly right. And then you got to go to your sales force with a message
Right.
to get out to the street. And, at the end of the day, all my sales force says, are we buying them or are we selling them today? What are we doing here, So, you go through this great presentation.
They just want a red arrow,
Exactly.
a red arrow down, green arrow up. And
Yeah,
you get the
exactly.
sophistication, folks, of a Jeff deGraaf, and you'd like to see a little more than that. I remember David Rosenberg at Merrill with Bob Farrell, and they agree and disagree in the sales force. The Thundering Herd would say, we need Rosenberg.
Yep, absolutely.
And everybody else would say, nah, we don't.
Bring it out there. So we got that. And today,
Right.
you have no economic data to argue over. We're going to get
Well,
a little
that's
CPI
blind.
data tomorrow.
Major shout out to Stephen Roach at Morgan Stanley, who really forced a fractious Morgan Stanley where you visibly saw them arguing day to day within the research at Morgan Stanley. We're going to continue with this real treat with Renaissance Macro. Jeffrey deGraaf, chairman, Neil Dutta, head of economic research, to really dive into some of the tensions forward that we see in the markets and in the American economy. We got a real treat, and it's too short a visit. Jeff deGraaf with us and Neil Dutta of RenMac. I'm going to go to you, Jeff, quickly. Neil, you quickly, because Paul wants to get one in before the market opening. Jeff deGraaf, what's the biggest mistake people make, and particularly the young kids day trading with technical analysis?
I think they have an illusion of control, selling high, buying low, selling high, buying low versus riding the trends.
What's a technical, riding the trends?
Riding the trends.
What's a technical stochastic failure of all this computer garbage today?
Well, again, it's that illusion of control that you think that you can predict what's going to happen versus just riding the wave of earnings and everything else.
What's the biggest mistake in our nation's economic analysis right now?
Is that you assume that relationships are stable from one cycle to the next.
One cycle to the next.
Boom.
All right.
I like that a lot.
Short
That's
and
true,
sweet.
too.
Jeff, a lot of people have been talking about AI, and it's created a bubble in the market. And I don't even know what a bubble is anymore. How do you define a bubble? How do you try to identify a bubble in whatever market you're looking at?
Yeah, it's a great question. It's a very hard thing to quantify. One of the things that we've come up with, it's very simple and it's been very, very effective. And I'll leave it for you, and you can put it in your back pocket. If an asset doubles in 2 years, you're in bubble territory. That doesn't mean it's done, but it means that you have to start talking about it as a bubble.
Look, they're getting YouTube love here. Tom Keene, please do a little more often like this with deGraaf and Dutta. They're loving it. I got tears to my eyes. They're loving it. Paul, a question to Neil Dutta.
Exactly. So, Neil, one of the things I think that our Federal Reserve is looking at is inflation, obviously. We haven't really seen it. Are we missing something here, or are corporations bearing the brunt of whatever inflationary pressures?
The hawks are missing it.
Okay,
the
talk to us
hawks are
about
missing
that.
it. I mean, ultimately, I think we're talking about big budget deficits, tariffs, policy risk premium, and yet the 10-year yield is below 4%.
Yep.
So I think that to me, it just basically demonstrates that a lot of that bad stuff was in the price. What's not? I mean, what the bond market probably has yet to meaningfully contend with is some kind of material slowdown in the economy. Because remember, the consensus has been revising up their GDP estimates for the last 5 or 6 months. So, to me, that's what's interesting. I'm not concerned about inflation. I mean, ultimately, I think nominal growth is sluggish, and if you put tariffs on, it'll just, force people to go pay more for one thing, and then they'll have to cut back on something else.
To get in before the market opened, and with Jeff deGraaf, it's a great privilege to have him in the studio today. Retail, right, fear of missing out, just shut up and buy, and institutions with all their sophistication maybe falling behind. How big is that gap right now between retail success and CTA and hedge funds? OMG, we're not getting it done.
Well, I think you hear the successes of the retail crowd, right? You don't hear the numerous failures,
really important
right?
point.
So I think that's really important. Look, we are now, and with the help of AI, we are now distinguishing between retail sentiment and the Reddit crowd and the X crowd and what the institutions are saying, right? So that is a part of our analysis now that we are using, is what's happening to the crowdsourcing versus what's happening to the institutions, and that's important because that's got that Reddit army is is real. They've got bayonets and pitchforks, and I think it's important to.
I got 20 seconds. It's too important a question. A listener emails in, Jeff deGraaf, can AI replace Neil Dutta?
No. His acerbic wit is unreplaceable.
Exactly.
I think I like a tweet that was out there today that said AI will replace bad science, and it'll probably replace bad economics as well. Right now, Neil Dutta, I'm being snarky there, but AI, is it a productivity plus, and are we underestimating America's productivity as we fold it into business efficiency?
I don't think so. I mean, I think right now AI is probably a productivity suck because you're spending so much time trying to figure out how to actually integrate it properly into your workflow, and that process is time consuming and keeps you maybe from doing more productive things. At least right here, right now. So, typically in a productivity boom, you don't tend to see productivity rising alongside the adoption of said technology. It usually happens after. So if you think about like the desktop computer, that was probably making its way in corporate America sometime in the early 90s. It wasn't really until the late 90s that productivity really took off. I think it's not, I don't think it's actually driving productivity right now.
My first earnings models at Paine Webber in 1986 were on pencil and paper.
Did you use a slide rule?
No, but
Neil
I did
Dutta's
pencil
too
on
young.
paper.
You
And if
use
you
a
wanted to
slide
change your estimates, you had to think long and
I
hard.
have my
That's
father's
what-
Kufel and Esser slide rule in my desk at home, 1947. That's when men were men.
That's where men were men.
Do you still have your original HP 12C?
I have an
Yes, we do.
HP 12C
Right.
with an AIMER CFA Institute sticker on it.
I do too.
I have the original one for back tonight. I'll be with the CFA Institute. It's such a nerd patrol here. Everyone in here uses an HP 12C. I'm sorry, Cy, this is never going to happen again, this level. Get one more in here with
Real
Jeff
quick,
deGraaf,
Jeff,
Paul.
from a technical perspective, is anything jumping out at you right now as a screaming buy or maybe a screaming short?
Well, we talked a little bit about healthcare, so I think that's making a turn, right? So you still have to be selective and looking at that without question. And look, we talked about doubling in 2 years. Gold has done that, right? So I think you have to be very, very careful with gold. The reason that's important is you have to start selling into strength. That's not something we tend to do. So we sell into strength when we're in a quote-unquote gold environment or bubble environment, and that's where we are.
Dennis Gartman, a note to me 2 days ago on his gold and yen call, he is sliding out of gold. He made real clear that enough is enough. Final question to Mr. Dutta. Neil Dutta, who's the next Fed chairman?
Oh, this is a loaded one. Well, I frankly don't think it's any of the people that are being discussed right now. And the reason is because if it was going to be one of those people, they would have already named them by now. I think the longer it goes on, the more likely it is, frankly, that Secretary Bessent. What do we know about Treasury Secretary Bessent? We know that, number one, which is the most important, he has the confidence of the President of the United States. And number two, he has the confidence of the financial markets, and those are two pretty good. And number three, he probably is interviewing all these people and is thinking to himself, like, I'm better than all these guys. I think, to me, that's sort of my dark horse pick.
Has this been okay? Have you guys had fun
It's great.
doing this? Okay.
Absolutely.
Can we do it again?
Yeah.
You tell us when.
2027.
Sounds
I think
good.
it could. Neil Dutta, Jeff deGraaf, they are Renaissance Macro. Again, we protect the copyright of all of our guests. You got to go to RenMac to get the pixie dust to Jeff deGraaf. and the detail of Neil Dutta. deGraaf, Dutta, they drive the market higher. The Dow Jones Industrial Average up 29 points. From New York City on YouTube, subscribe to Bloomberg Podcasts, Bloomberg Surveillance.